assets. Liabilities also have two categories, current and long-term. Now, if current assets are those assets that are going to turn into cash in the next 12 months, what are current liabilities? They're the payments within 12 months, okay? So one person's current assets could be another person's current liabilities, right? Give you an example. Accounts payable is the other side of the desk from accounts receivable, isn't it? Accounts payable are our 30, 60, 90-day accounts that we owe. Accounts receivable are 30, 60, 90-day accounts that we're going to receive. One company's accounts payable is another company's accounts receivable, right? And if it were possible, and if this were a perfect world, we should be able to add up everybody's accounts receivable in the world and add up everybody's accounts payable in the world, and the total should be the same, right? Yeah, but we could never do that. Obviously, we could never do that. But that's the concept there, okay? So my accounts payable is going to be my vendor's accounts receivable, okay? Next account. The accounts payable was a very common account. Flooring or inventory financing is a highly specialized account, but very important to the businesses that use it. Flooring payable or the inventory financing account is defined as financing for higher cost items that have a serial number. They've got to be trackable. So that's the reason why we need to have a number attached to them. And they've got to be higher cost, or else the bank or finance company isn't going to make the effort, or it's not going to be worth their time to do the financing. Now let me just give you an example of how flooring works, because it's this one concept that makes it possible for us to purchase cars off of a lot instead of out of a catalog. If I wanted to be a car dealer, I could call Ford up and say, hey, Ford Motor Company, I want to sell your cars. And I've got this lot up here that is just perfect. The traffic is there. People will be there. They'll be buying your cars like crazy. And so what I want you to do is send me 100 cars, 100 Fords. Okay? What do you think Ford Motor Company is going to say to that? Show me the money. Show me the money, I'll send you the cars. Well, how much is it going to cost me to buy 100 Fords? We're talking hundreds of thousands of dollars, maybe even in the millions. Okay? Depending upon what cars we're going to get. Now, I've got to have those cars, though, don't I? If I'm going to sell them. So, what I do is I go down to the bank and I set up a line of flooring. They have a special department just to work with dealerships to set up this thing. And I go into the bank and I say, can you set up a flooring contract for me? And they give me a document. It's multiple pages. And down at the bottom of the last page, it requires 3 signatures. Those 3 signatures are the manufacturer, which of course in this example is Ford, the dealer, which is me, and then the bank will also be signature on there. So 3 signatures. 3 parties are involved with this one contract. Now what happens is I need to now, once I get those 3 signatures, I can call the manufacturer. So here I am, calling the manufacturer saying, now send me 100 Fords. I have this line of credit set up. Now they're not going to laugh at me. Okay? Now I've got a bank behind me on this one. So they say, no problem. We'll put them on the assembly line. They should be to you within a few weeks. Okay? At which point, once they're through and assembled, the manufacturer sends an invoice to the bank for those 100 Fords or whatever it is. Okay? The bank looks, they've got a line of credit set up, so they send the money to the manufacturer, and the manufacturer puts on the rail line 20 cars for me, or 100 cars, or whatever it is. Okay? Now, Is the manufacturer happy? They got their money, they've sent the goods. Am I, the dealer, happy? I got the goods. Now I can have my sales and get customers in there and so forth, and I can sell those. Is the bank happy?
Sort of.
Let me tell you, the bank is always happy. Okay? Yes, the bank is happy because one thing I didn't tell you was they are charging me interest for every day that I haven't paid off those cars. They keep track by serial number of all the cars that they paid for on my behalf. And each month they come down with the list of those cars, the serial numbers, and they go down and just check to see if those cars are still there. If I sell a car, I have 24 hours to pay that car off. If I fail to pay it off within 24 hours, I am out of trust. Okay? And the bank has the right to shut me down. So what they're looking for when they go down and check those serial numbers is they look to see if there's any that I have sold and haven't paid for yet. And if there are, and they want to be ugly about it, they could shut me down at that moment. They wouldn't do it. They'd come back the next day and do it. Okay? Now, every dealer is out of trust from time to time. Every dealer is. Usually it's because of oversight. They just forgot to pay it off. Okay? And no bank wants to shut the dealer down. They lose all that potential income. Sure, the dealers bring in their contracts. They don't want to shut the dealer down. But if they can see that the dealer is starting to abuse the money, then they will. Okay, and they have. And there's a dealership not too far, just a few years ago, just right out here, a couple miles away, that was selling motorhomes. And we know this because one of our students came in, and when we were talking about flooring, she said, "Oh, I never realized what was going on." But a few weeks after she bought the motorhome, the salesman called her up and said, "To show you how grateful we are to you as one of our customers, if you will bring that motorhome in on Thursday, we will clean it up and change the oil for you." So she brought it down on Thursday thinking, what wonderful people, and left it there. That night she came back. The motorhome was all ready. It was clean. The only thing that caught her attention was it was on the front line with all the other brand new motorhomes. She was a little bit miffed, thinking that maybe that they had been taking customers through her motorhome with her pots and pans and her stuff that was in it already. What really happened that day?
They wanted it there for the day.
The bank was coming by. The bank always announces beforehand so they can get all the salesman's cars in there and everything. And the bank was coming in that day and saw that motorhome and checked it off, thinking it was still theirs, not realizing that it had been sold. Okay? And it was just a few weeks later that dealer was shut down. And they don't do it kindly. They don't give them advance warning. They come in. They say, you got 5 minutes to clear the joint. We're taking over from here on out. And then the first thing they do is take all the existing inventory and get it behind a fence someplace under control. Why? Because if that happens, part of this flooring agreement was that the manufacturer would buy back any unsold inventory. Okay? So as long as that inventory is on their lot, the bank is protected. They know they can get their money back from the manufacturer. But when it's sold, they no longer have that protection. So what do they tell the dealer? You've got how much time? 24 hours once you sell it to pay me back. Okay? If you don't pay me back, you're what? Out of trust. Okay? So that's the way flooring works, and that's what enables these dealers to buy 100 or 200 or 500 cars for their lots. So they can have every color with every option there available so that you can find the car of your dreams just walking in the dealership and drive it home that night. Okay? If it wasn't for flooring, we would be buying cars out of catalogs instead of there. And it's a great system as long as the dealer doesn't abuse it. But if the dealer abuses it, it's a problem. Now today, car dealerships and other dealers like that are doing well because the economy is strong. If interest rates start going up very fast and high, not only will people stop buying, but dealers will have to pay huge flooring interest, and that's what created major problems a few years back in the car dealership, in the car business. This is over a decade ago. But dealers all over the country lost a lot of money, and most of them closed because interest rates were too high. They couldn't afford the flooring interest alone on keeping those cars. Okay? Okay, customer deposits. Or sales tax payable, excuse me. Does it surprise you that when you collect sales tax, you have to pay it to the state? There are a lot of businesses that act naive and think that they can keep the money. They can't. I actually had one client that sincerely, genuinely believed that that was his money, and when sales tax rates went up, he thought it was the way that the state improved his profits. So he liked it. He never understood why people were so upset about, businesses. But in reality, we have to pay out anything we collect, every dollar. So anytime you collect sales tax, it immediately becomes a liability in the sales tax payable account. So if you've got a $500 balance in there, that represents $500 you have to pay to the state tax commission. Next account is customer deposits. Customer deposits are any amounts you receive from a customer in anticipation of a future sale. A sale doesn't happen until the goods are delivered. Yet oftentimes customers will pay us money in advance. A good example is any layaway. If you make a layaway, the goods aren't delivered until the final payment is made, right? So it's a customer deposit until that occurs. Not only does it happen in layaways, but if there's a customer that has, you might have to make a special order of a product. In order to make sure that they're sincere, you might ask them for a percentage, 25% of the cost. That's a deposit. It's not a sale until what happens? Till what? No, doesn't matter when it's paid for or not, till the goods are delivered. The goods have to be given before the sale occurs. So what does every car salesman want you to do after you sign the dotted line?
Take that car.
Take that car home tonight, okay? Because they realize the sale didn't occur until what happened? Those back wheels crossed the curb. That's when the sale occurred, and that's what they want you to take it home that night. Okay, now the remaining accounts down there are dealing with payroll, and when we get to payroll, we'll talk about how each of those are calculated and so forth, but suffice it to say, when you've got employees, you got a whole bunch of liabilities to worry about, okay? And so we're going to show you how to account for every one of those liabilities, how to calculate them and do those things when we get to payroll. But those are current liabilities. Then long-term liabilities are what? Loans that what? Take more than a year to pay off, okay? They're longer-term liabilities. And that might be the car loan, the business loan, anything. Why isn't flooring payable a long-term liability? Because you expect to sell the inventory within the year, right? And that means you got 24 hours after that time to sell. So yeah, it's definitely less than a year, okay?